Good morning. It's great to be with you again. Tariff day, 1 August, has come and gone. Markets are climbing to new highs. Risks keep escalating. It all needs to be thoroughly digested. There's a lot that doesn't make sense, but we do have some good insights and look forward to sharing them with you today. But first, let's have a look at the month of July. All round, pretty solid performance. World equities up 4% in rands. China, the outstanding performer for the month, up 7%. That's on the back of their technology sector, which drove broader China. What else is interesting? US equities up 5% compared to Europe, which was only basically flat. So interesting to see some rebound there with Europe losing some ground compared to US. A lot of that was on the dollar, which strengthened towards the end of the month. NASDAQ 100 outperforming FANG. That's also an interesting one for the month. Pretty close, 5% versus 4%. But given the fantastic numbers that have come up with FANG companies over the last 2 weeks with the recent results, especially from Google and Microsoft, I'm quite surprised that NASDAQ beat FANG. Otherwise, overall, everything up 2 to 3%. SA bonds looking strong. SA property up 2.8. SA equities up 2.3. Emerging markets up 3. So yeah, pretty much everywhere was good except for Japan. They had elections, which surprised to the downside. And healthcare. Healthcare was severely impacted by Novo Nordisk, one of the bigger companies in the healthcare index, and they had some bad results. Possibly a case of the new CEO sweeping clean with his broom, so maybe an opportunity coming up down the line. But for now, just more bad news, unfortunately, from the top 10 companies within the global healthcare sector. So how does that transform to fund performance? Pretty much in line. You can see that China, Signia ITRIX MSCI China feeder ETF, 6.6% for the month, number one. Also, barely in number 2 position, just pipped by FANG over 12 months with a fantastic return of 36.5%. So China certainly continues to deliver returns over the short and long term. Fourth Industrial Revolution is up in second place, 5.4%. It is not doing as well over 12 months. As you can see on the 12-month section, FANG has moved into the number 1 position. It took a while. The FANG stocks were hit quite badly about 2 months ago, but they've recovered and they're now back number 1 with a really decent 1-year return of 37.5%. EM's up 3rd place for the month, driven by China mostly. South African property index in 4th place. That was helped by our lower bond yields. I'll talk more about that in the South African section. We did go overweight South African bonds and South African equities earlier in June, which worked well for us. And yeah, South African property sector also up over 12 months, 24.3%, just sneaking into the final position there. So overall, a lot of tech leadership, FANG, MSCI China, which is driven by their tech, Fourth Industrial Revolution, emerging markets, which also got obviously big tech exposure through Taiwan. So besides SA property, very much a tech-focused recovery at the moment. And we have seen huge amounts of spending being announced by the big FANG companies, and looks like that tech capex is going to continue, even though it's reaching all-time record highs. Certainly something to be concerned about longer term, but right now, spend. The guys are trying to get as much capex in place as possible, and that to some extent that makes sense because they want to do as much as they can ahead of tariffs. And that brings me to the next slide.
Essentially, they were exactly as anticipated, very low inflation. So what you should do is lower the rate. The Fed should lower the rate immediately.
If only it was that easy. Yeah, so markets are definitely up. They're up on some decent results in the tech sector. They're up on the weaker dollar, but a lot of the strength in markets is on the back of Trump and him trying to push down interest rates. So when it comes to setting interest rates, you have in the US, it's the Federal Reserve. They're independent, or at least they have been independent for the last forever. But the Fed has a dual mandate. On one hand, it needs to try and make sure inflation doesn't get out of control. On the other hand, it needs to support growth when growth gets too low. And the whole point of a central bank is to try and reduce the volatility in your economy so that you don't have huge hot spurts followed by deathly depressions and huge stop losses. So trying to keep the markets and your economies as stable as possible. Now, the way they do that is if inflation rises, they push up interest rates, which reduces demand because people are now paying more on their mortgage and their cars, and as a result, inflation comes down. And that's why there's an old market adage which says, bull markets don't die of old age, they are killed by the Fed. And that's spot on. I mean, when bull markets get too excited, the Fed, to avoid things getting really, really out of hand, they raise interest rates to make things come down a bit. Now, on the other hand, there's something called the Fed Put. And that's the notion that, well, if you step back to a market, if you buy a put option on a market, it protects you from the downside. So hence the word put. But the reason it's called the Fed Put is that market participants and corporates believe that when growth slows, particularly employment growth, but also overall economic growth, the Fed will cut interest rates to try and stimulate growth and again to try and make things more stable. But now I've got a strange situation where inflation is high. It's above the Fed's target. Not only that, but inflation is likely to get even higher as tariff inflation passes through. And you've got Trump saying that the Fed needs to cut by 300 basis points or 3%, which basically would stimulate markets aggressively. And I think that's what has driven markets to some extent, is that the belief that we're going to have, despite high inflation and despite high growth, or at least average growth, we're going to see 3% of interest rate cuts in the US. Now, it's not only that people are excited about that from the fact that it'll support growth and it'll support markets, but it also makes people a bit worried about inflation, because the whole point of raising interest rates is to get inflation to come down. If you start cutting rates when inflation is high, inflation could get even higher. And that's why we've seen this huge switch out of the dollar, out of bonds and out of cash, as people start to look for real assets that are protected against inflation, because they're worried that inflation might go to 100% if you start cutting aggressively while there's still some strong growth and some strong inflation. And that's why we've seen Bitcoin rally, we've seen commodities rally, we've seen equities rally. Basically anything that is a real asset to property has been going up as people desperately try and look for inflation hedges. So right now, because of the Fed Put, because of the fact that interest rates could be cut when they shouldn't be, that makes market participants more worried about inflation risks than about growth risks, and hence that's how markets have responded. Now, it's not just monetary policy. So yes, there are a number of global tailwinds. So the Fed Put is the big one I'm talking about, which is a very loose monetary policy. But then there's also the dollar weakness. Dollar weakness helps economies by boosting commodity prices, by lowering funding costs, and overall easing financial conditions. So having a weak dollar is very good for global growth. The Fed Put is good for global growth. But not only have you got those two tailwinds, but look at the charts on the right. It's actually quite terrifying. You can see that the US, which is the top, then China in the middle, and Japan are all achieving between 8 and 10% of GDP in fiscal stimulus. Now, that is a huge amount. And to put that in some sort of comparison, within the EU, prudential authorities prevented all the individual countries from having more than a 3% budget deficit. Here you've got these large countries, largest countries in the world, sitting at 8 to 10%. So let's say 9. That's 3 times what the EU has allowed. Of course, that was in the past. Now it's not only Japan and China and the US, but EU is looking to spend 5% of their GDP every year on defense. So that takes the EU from 3 up to 8. So suddenly you've got this huge coordinated fiscal stimulus. Now, the point of fiscal stimulus is that it's supposed to be counter-cyclical, just like monetary policy is there when growth is low, you want to cut rates. When inflation is high, you want to raise rates. Counter-cyclical fiscal policy is the same. When your economy is doing well, the government shouldn't be spending much. But if you're in a recession or depression, then the government spends. So now we basically are running on all cylinders. We've got 3 times the amount of fiscal stimulus we should have, even if things were poor, and they're not. I mean, growth is actually okay. Plus huge monetary stimulus, the Fed Put, the dollar weakness. That's all what's driving investors into not bonds, not cash, and not the dollar. Now, the issue is markets are at new highs, and they seem to be discounting any risks that could exist. Yes, I understand there's definitely a bit of fear. There'd be the fear of not having an inflation protection is driving them into gold or Bitcoin or equities. But there's a lot of risks which could see things turn around quite quickly. Firstly, let's look at tariff day, 1 August. There were a lot of deals that were concluded. Some weren't. Mexico was delayed, but a lot were. But the details are nearly double what we've seen. So, the average broad tariff that was on all countries was 10%. If you look at what's been agreed upon, we've got India at 25 plus penalties, Vietnam at 20, Korea, Japan, and Europe at 15, Canada at 35%, but it's only on some sectors. Overall, it's actually not that bad. It's around 6. And then we've got the huge other penalties and tariffs that aren't really trade related and are quite difficult to understand. It's the penalties on transshipments out of China. It's the 50% tariffs on Brazil. It's the BRICS aligned 10% extra tariffs. And obviously the 100% Russian secondary tariffs on anyone who buys Russian oil or gas. So there's a lot there which puts the statutory level at least 20% from 7 August when these go into effect. So one risk is that tariffs are double what we were expecting, and actually quite close to the Liberation Day in April. But I think what's more concerning is that even that 10% that we had, in fact, in June, the effective tariff was 9.5%, even though the statutory level was 14 because of goods still being on different shipping routes and inventory that could be sold, delayed enforcement. There were a number of reasons why it was only 9.5. But despite only being 9.5, we saw goods inflation jump to 0.55% in June, which is a huge number. So overall inflation didn't look too bad because some other things brought it down, but we are seeing this inflation come through. Copper is not as much of a risk, but when Trump announced the copper tariffs, copper surged in the US because it was very much a US thing, US issue, by 17%. They subsequently fell 19% when he decided that copper wasn't going to be tariffed anymore. But the issue, the bottom line is, I think we're going to see there's a strong risk that inflation from tariffs is going to be higher than expected. Not only are we working on a delayed number, so maybe only July or August we'll see the real impacts of 10%, but now you've got to worry about doubling that at 20% and see what that does to the overall economy and to investors' appetites. And I think that we could be in for a bit of a shock. Then there are 2 growth headwinds. They're not as big, but they certainly are a concern. The one is the rollback of Biden-era immigration policies. So Trump has basically removed legal workers' rights from 1.1 million people. 1.1 million jobs, or nearly 1% of US labor supply, is suddenly gone. Now, there's a good chance that those people will actually get illegal jobs. Obviously, will earn a lot less. But I doubt the full 1.1 million are going to go back to where they came from. Some majority will try and stay in the US. So maybe it doesn't have as big impact on US labor supply as we think, but certainly it leads to a lot of uncertainty. And the bigger one that I have mentioned before is the tariff front-loading. So 1H 2025 was strongly supported by everyone buying ahead of tariffs, trying to get as much inventory as they can. And I spoke about tech capex has been huge in the first half as everyone's trying to get as many semiconductors and other things in place in case there are tariffs that are announced on various technology supply chains. But as we move into the second half, those orders need to normalize. So suddenly you've been buying here, inventories at as high level as you can take. So you're going to stop buying for the next 2 to 3 months while your inventory normalizes. And we're already starting to see that come through the numbers. So the June PMI for the US for manufacturing was at a 9-month low at 48, so contracting. Not only that, but we saw some quite scary payroll revisions last Friday in the US. 258,000 payrolls were removed over the last 3 months, and the unemployment rate rose to 4.2%. So things are definitely slowing. Not to recession levels. I'm not saying that. That's why we've been overweight equity and overweight risk, because we don't think we're going to see a recession. But there's definitely going to be a lot more volatility in the next 2 to 3 months. July and August are historically, if you look back over the last 3 decades, the worst performing months for equities. So we've been through July. It was a good month. We still have to get through August, and there might be some volatility as these tough growth numbers start to come through, or as the scary inflation numbers start to come through. But until then, there's just too much stimulus to fight the Fed, so we are not. Now, another thing that's quite important for your market outlook is the price of the dollar. The only time that Europe has outperformed the dollar over the last 20 years was in 2006, 2007. And that wasn't actually because earnings grew faster in Europe. It was because the dollar weakened relative to the euro. So the price of the dollar is important. And there's been a lot of interesting things being said about the dollar in the States, particularly by our secretary here, Scott Bessent, Treasury Secretary. So the first thing I've already spoken about, which is the Fed put, or the pressure to fire Powell, or at least find a new candidate to replace Powell when his term ends early next year. The two front leading contenders are Kevin Hassett and Kevin Warsh. Now, what is interesting is that they were both actually hawks, if you look back along their career. But it's only in the last 6 months they've suddenly become very dovish. So it's interesting to see how long they stay dovish. Maybe they'll come into the Fed and they'll save the Fed's credibility altogether. It'll be interesting to see. But right now, those are the two leading candidates, and they are talking about aggressively cutting interest rates and supporting growth despite inflation. So that's, worrying about the Fed policy. Then there's something called fiscal dominance, which is something that our friend here, Scott Bessent, and Trump have mentioned. And that's saying, well, we've got all this debt, we've got huge fiscal stimulus, 9% of GDP, how do we pay for it? We can't afford it because interest rates are so high. So let's get clever. Let's artificially push down interest rates. So we'll cut the short end, we'll cut interest rates, and then we'll borrow there by issuing treasury bills, which is basically money market or cash, and not issuing further up along the bond curve and not issuing bonds. So that's quite clever. It will get your costs down, but it has a lot of indirect consequences which are not good for either the independence of the Fed or the overall working of inflation. Because when you start switching from bonds to T-bills, you immediately inject liquidity into the economy. And the more liquidity you have in the economy, the faster the economy grows. That leads to higher inflation expectations, which leads to a steeper yield curve, which actually makes it more expensive for people who are borrowing money for houses and corporates and things. So while the government may be able to borrow cheaply at the short end, they're going to crowd out everybody else at the long end. Anyway, the overall impact of fiscal dominance is a weakening of credibility for the Fed and a weakening dollar as a result. So now we've got the Fed put, we've got fiscal dominance. We've also got, this is what the quote is on the screen, quite an important point. I mean, since Bessent and Trump came in, they've been talking about the strong dollar policy. So we all thought, well, they want a strong dollar. No. Turns out that's not what they mean. They've changed the meaning entirely. A strong dollar doesn't mean the dollar must be high. It just means the dollar must remain the reserve currency of the world, which it probably will, at least in the short to medium term. So now we've got the leading players or treasury secretaries saying, the dollar can weaken. And then there's the overall other political influences that we are seeing, which make people worry about what's happening in the US. Trump firing the messenger, the head of Bureau of Labor Statistics. Yes, there were some big revisions downward to the payroll numbers. I mentioned that on the last slide, 258,000 negative revision. And Trump saying, listen, those numbers aren't real. So he fired Erica McIntyre. So there's no judgment here. Maybe she did make a mistake, and those revisions are quite large. But still, when you start having your president influencing your Fed chair, the person who's counting your inflation and other important numbers, you do start to wonder to what extent you're going to end up looking like China, where Xi Jinping decides what the numbers are and then releases them. So a bit of a concern for the dollar. So overall, we do think the dollar is going to weaken. In the medium term, at least. So I've spoken about the Fed policy, low interest rates will weaken the dollar. I've spoken about a dollar policy that's no longer trying for a high dollar price. We just want to either the global reserve, and fiscal dominance, which leads to a steepening of the yield curve and a weaker dollar. So those are headwinds to strength and likely to lead to weakness. Then two longer term things, and they really are longer term and don't really impact as much in the short term. One is the dollar is expensive. But the dollar has been expensive, and all currencies can stay expensive or cheap relative to their purchasing power parity, or the Big Mac index, how much it costs to buy a Big Mac in the US versus a Big Mac in South Africa. That can exist, that disparity can exist for decades. So, but it's important to know the dollar is expensive. Then there's a de-dollarization, which we've spoken about many times, and that's just that some countries are tired of Trump, tired of the dollar dominance. And so they're now trading commodities between their two countries in the domestic currency, whatever it may be, between Russia and Dubai. They are trading in their own currencies. Likewise, Russia and China, Brazil and China, all trading in their own domestic currencies. So there's less demand for dollars. And then countries are diversifying their reserve holdings, buying gold instead of buying dollars. Now, this is something that's going to continue. The dollar has lost some of its reserve status. So it's dropped over the last 20 years from 70% down to 60. So, that trend will continue, but it's going to take at least another decade. It's not something that you are going to trade on in the short term. Now, what has impacted the dollar in the short term, besides sentiment, and yes, there's a lot of dollar policy sentiment that I spoke about, is dollar hedging. So it turns out that there's a large stake of US equities and US bonds that are held by foreigners, particularly Asia and Europe. And between 2014 and 2021, they didn't hedge the dollar because the dollar was strengthening. But this year, as the dollar weakened, they were forced to start hedging. And the more the dollar fell, the more they had to hedge. There was this negative feedback loop. And that was despite the fact that hedging costs are expensive. So the chart on the right just shows the interest rates in the US less the G10. So that's your major developed markets. And you can see there at the moment that spread is about 2%. So that's just where the red arrow is. But that spread's going to narrow down to probably about 1% as the Fed starts to cut rates and everybody else stays flat. And that is important because as that spread narrows, so the cost of hedging the dollar shrinks. And as the US yield curve steepens, so again, the cost of hedging shrinks. So right now, the cost of hedging is expensive. And that's why we do think that there could be a short-term bounce in the dollar because it is oversold and there's a lot of spec positions and the hedging costs are high. So we might see a small bounce in the dollar. But longer term, as US cuts rates, that hedging cost is going to come down and foreigners are going to start hedging the dollar, which will push the dollar lower. Now, this is very, very, very different to saying that the US is weak. The dollar is likely to be weak, but the US has still got a lot of tailwinds. Exceptional US productivity growth. I mean, the productivity in the US is more than double the rest of the world. AI leadership, strong fiscal support. And then it's not just sharp money that flows into the US, but a lot of Trump's trade deals require significant US investment commitments. So that's direct foreign capital investments into the US from these trading partners. So that all means buying dollars. Not just that, but as an interesting aside, I mean, it's quite small, but as stable coins, the cryptocurrency stable coins, as those rise in importance, they have to be backed by US assets, US bonds in particular. And that will see an indirect demand for dollars coming through from that. So there's definitely two sides to the story, but overall, until the US becomes exceptional again, till their growth recovers back to its 2% level or 2.5% level, the dollar is definitely faces more headwinds and more downside than upside. So that is why one of the reasons why we are overweight emerging markets is because a weak dollar is very good for emerging markets. Now, this month we had President Xi Jinping calling for the regulation of disorderly low price competition. Basically, the big concern in China right now is deflation. And why is that a concern? Well, if you think that the car you want to buy today is going to be 10% cheaper in a year's time, you'll just wait. And that's exactly what we're seeing in China, is that there's deflation happening and people aren't spending, consumers aren't spending because they're just waiting for things to get cheaper. Now, that's your worst case scenario for capitalism. Capitalism needs everything to go up. It needs populations to go up, it needs prices to go up, because the moment you just get stuck in a deflationary trap, everything implodes. And so this is very important, that this focus on driving consumer confidence and consumer spending in China. And just look at the chart on the right here. The blue line is price expectations index. So that's inflation expectations. And you can see that that's plummeted over the last 5 years. And the green dotted line shows consumers saving intention. So as deflation accelerates, people start saving more and more and more, because if you save long enough, you can eventually buy 2 cars for the same price as one. So why would you buy one today? So that is the big issue for China at the moment. Yes, Q2 GDP was stronger than expected at 5.2%, which is above the China's target. but we're still seeing some signs of malaise. Property downturn is continuing, and there's a big concern that as the tariff front-loading ends, that will certainly slow down China's exports. And the strong Q2 GDP growth of 5.2% was driven by exports. So that would see a slowdown. And as a result, we have Xi Jinping trying to turn around that deflationary setting and basically calling for ways of stimulating domestic consumption. And that's the only way for them to get out of this deflationary trap that they're in. Now, one of the good news items for South Africa and for China is copper prices. We saw copper prices rally nearly 20% when Trump announced the tariffs, and then fall 20%, nearly 20% when Trump took them away. But that didn't have as big impact on the rest of the world copper prices because it was very much a US issue, and the US only consumes 6% of global copper compared to 60% of China. And that just shows how China is a global manufacturing powerhouse. Yes, Trump wants to try and rekindle some of US manufacturing ability, but the US manufacturing is just insignificant compared to China. And this copper demand just shows that. So despite the volatility in copper prices do remain overall elevated, even in the rest of the world, not just in the US. And that's from a lot of extra demand that's expected. Now, copper was seen as the green metal. It was all about EVs, electric vehicles, and solar panels, and moving away from carbon power, and that all requires a lot of copper. But we have seen that actually start to slow down. As everyone knows, Trump doesn't care at all about climate change. He doesn't believe in it. And we've also seen, just generally, not just in the US, but overall, a switching of preference from electric vehicles to hybrids using more platinum and less copper. But copper demand is still quite strong. And the reason now is the shift has moved from a green metal to the AI metal. And we're seeing that copper demand is expected to add, well, the US is expected to add over 1 million tons of copper demand every year by 2030, which is more than twice the refined copper deficit in 2024. And this is all for AI data centers. So these huge sprawling data centers, warehouses that are out there to try and process all the AI data. It's leading to a huge amount of electricity consumption, a lot of property focus where people are no longer building residential or building shopping centers. They're all building these warehouses. And that's also at some point going to lead to a bubble. But right now, the focus is very strong, and copper seems to be getting a lot of support from your AI data centers. So overall, China, more stimulus is required, but growth continues to beat expectations. And their strong focus on the tech sector is allowing their stock market to work very, very, very nicely. And we do expect that to continue, which is why we remain overweight emerging markets and China.
These allegations, therefore, call for an urgent and comprehensive investigation. To address these allegations and the implications of these allegations, I'm establishing a judicial commission of inquiry.
Our president does love his judicial commissions of inquiries. There are quite a few of them going on. Well, at least he's very good at starting them, not so much at ending them. But we had a lot of political noise this month. We had Ramaphosa, we had some TNU instability again. And then more recently, last week, we had a bit of infighting between National Treasury, our finance minister, and the South African Reserve Bank about the inflation target. So a lot of toing and froing about different policies and what's going to happen and what's not going to happen. But the bad news is that tariffs have arrived. Well, they will on the 7th of August. And it's very difficult to get a clear answer. But it seems like not only is South Africa getting 30% tariffs, which is definitely on the high end compared to everybody else, but we're also going to face the 10% BRICS tariffs. So that's a 40% tariff, and certainly not good for growth. Now, as I mentioned before, we did go overweight South African bonds and South African equities beginning of last month, and that was for two reasons. One is, why did we go overweight South African bonds? Well, we are already overweight South Africa. We were already overweight from the beginning of the year. Emerging markets, particularly their local currency bonds, because emerging market local currency bonds have got really high yields, much higher than developed markets, while those same countries, those same emerging markets, are actually seeing inflation fall much faster than developed markets. In fact, some of them have lower inflation than developed markets. So it's a great arbitrage. You're getting higher yields with lower inflation, and that's why we've liked emerging market bonds. But this month they actually added to an overweight in South African bonds. Why? Well, the silver lining from low growth, it's a very narrow and thin silver lining, is low inflation. If you have no demand, you can't push through your inflation increases. Companies have to absorb them because the consumer just doesn't have the ability to pay for higher prices. So you get not only a shrinking volumes, but a very low inflation. We saw SA inflation come through at 2.9% for the month. That's below the current band of 3 to 6%. I'm not quite sure where that band is going to end up, but still very low. And we saw a bit of wage inflation easing, all very good for our bond market. The other reason that we like South African bonds, they have rallied strongly to support them, but we did expect SARB to cut rates, and that now means that bond yields are giving you better yields than even our enhanced income fund, which has got a great 2.5% higher than JIBAR, but the steep yield curve in South Africa is giving you slightly better yields in bonds. And then finally, and I think this is quite important, and this is why we also over SA equities, is just the commodity rally. In the past, we've had very good budgets, both final budget and medium-term budget policy statements, because of tailwinds that are beyond our control, mostly commodities. And we're likely to see that happen in October and hopefully again next year, where the huge rally in platinum and gold and iron ore has driven our terms of trade massively. And not only that, but it means lower trade deficits and lower budget deficits, because suddenly you're raising more taxes on those high commodity prices and you're exporting more. And I have spoken about the limits to our exports because of Transnet, so it's not a perfect story. But if you look at the charts on the right, it's just fascinating. So the green line is the rand. So this chart's about a week old. It was at 1768. The blue line is JP Morgan's average EM basket. So that's got 10 emerging market currencies, of which one is South Africa. And you can see there, it's the rand has been slightly stronger than the overall basket. But nowhere nearly where we should be based on the orange line, which is our terms of trade. So platinum has about a 30% impact on our terms of trade volatility compared to gold at 11%. So platinum is by far the bigger driver. And platinum hit $1,500 an ounce before it pulled back a bit. So you can see there on the chart, I mean, the rand should get 14.5 based purely on terms of trade. Now, obviously, there's a lot more going on in South Africa. We do have large amounts of debt, and we do have no growth. We do have an inability to export and even mine some of our commodities. So yes, I'm not saying the rand should be at 14.5, but I do think that our budget will benefit from higher tax revenues because of higher commodity prices, and our trade account will also benefit because of higher exports. So all of those are good for bonds. And then also good for SA equities, not because of South African equities or SA Inc., but because of resources, which are continuing to rally on the back of these high commodity prices and are likely to continue to rally given the stability we're seeing in platinum and palladium in particular, which is quite important for the country. So an interesting viewpoint where we've actually gone overweight South Africa. We are overweight risk everywhere, so we also overweight global equities, and we overweight emerging market equities, and we overweight emerging market bonds, but just adding a bit to that, sort of switching a bit of that from emerging markets into SA. Okay, so where does that leave us? Overall, overall, we faced with some serious tailwinds and some serious headwinds. What are our headwinds? Well, as I mentioned, second half of 2025 volumes are going to fall because of the end of tariff front running or front loading. US immigration policies are tightened, which could weigh on US growth, and economic uncertainty around these never-ending tariffs continues to rise. Not only that, but earnings are still, despite surprising to the upside, one-year forecast earnings are still lower than what they were forecast to be in 2024. So earnings are still on the back burner. ISM surveys, which are your best forward-look indicators, show high inflation is on its way and low employment. So what you don't want, stagflation, because then the Fed gets stuck. Well, unless there's some manipulation of the Fed, but as the growth is falling, employment growth is falling, because inflation is sticky, they can't cut rates, which is exactly what they did in July. They didn't cut rates. Now, despite all these risks, what is fascinating is the chart on the right, which seems to see that markets aren't concerned about tariffs at all. So the green line is the UBS Tariff Loser Index. That's a bunch of companies that would really do poorly if tariffs are put in place. And you can see there how they fell, what, 30% in April around Liberation Day, but they've recovered almost all their losses over the last couple of months, despite the fact that tariffs are now back in place from tariff day, pretty close to Liberation Day. Similarly, the blue line is the Goldman Sachs stagflation basket. And again, around Liberation Day, you saw this huge increase in all the winners from stagflation. So those are your defensive stocks, your utilities, telcos, healthcare normally, all your safe stocks did really well. But they've again now actually below where they were before Liberation Day. So the market doesn't seem to think that there's any risks from tariffs. Equity markets are at new highs. Tariff losers are back to their levels. Stagflation basket back to its previous levels. There doesn't seem to be any concern. Meanwhile, you do have inflation swaps, which have risen to 3%. This is 2-year inflation swaps in the US. 3% is the highest they've been since COVID. And we've got statutory tariff levels at around 20%, double the 10. And we haven't even seen the full impact of the 10% yet. So I do think that markets are a bit complacent around the tariff risks. But I understand, and we have taken the same position. You can't fight the Fed, and we certainly aren't. So the Fed put and everything else, the weaker dollar, all those policies that are being put in place, is combined with the massive fiscal stimulus around the world, Europe, Japan, China, the US, those are all supporting markets. When you've got loose monetary policy, loose fiscal policy, in an environment where growth is actually okay, well, markets are going to do well. And in particular, you're going to look for real assets because inflation is a concern. So equities, Bitcoin, gold, platinum, all going to continue to do well as people chase growth and don't worry about inflation. And yeah, so that's why we are not fighting the Fed. We are overweight equities. We are overweight emerging markets. We do have we're overweight South Africa to get some more resource exposure through commodities. That said, we're very, 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 very nervous that the market is not at all pricing in some of the risks, as that chart shows you on the right. And whether that risk is lower growth, like we saw in US non-farm payrolls on Friday, or as we're seeing in US manufacturing PMIs, lower growth in the US because of immigration or because of tariffs. Either way, if growth falls too far, markets will get spooked. And likewise, if inflation starts to come through higher than expected, which will force central banks around the world, in particular the Fed, even though there's some constraints there, to hike rates, well, the markets will also get spooked. So right now we've seen bonds rally because they're more concerned about the low growth, where we think that there's actually probably, we're not in the recessionary camp. We think there's a higher risk of inflation coming through and growth remaining robust, as opposed to falling into recession. So we remain underweight double bonds, particularly US bonds, the developed market bonds, and we prefer EM bonds, which are supported by the weaker dollar and the lower inflation in EMs. Which again, it's pretty much cyclical. As emerging market currencies strengthen, so import inflation falls, and so the central banks can cut rates, which stimulates growth, and it's all a very happy cycle for emerging markets. Although there are idiosyncratic risks, like we see in South Africa and Brazil. So that's where we are for the month. We're maintaining our overweight, but we have very tight stop losses on our positions, and we're very concerned about the market not fully appreciating the risks that are in place. Okay. Let's go through some questions. Yes, we do send CPD certificates for those who join, so please look out for that. Louise says, the Signia money market A class delivered negative return for the month of July after fees. Can you provide the context? Louise, that sounds surprising, but I'll we'll have a look and get back to you. But yeah, the Signia money market A class, that doesn't sound right. So I'm guessing there's some sort of error in one of the systems that are reporting, but I'll confirm shortly. Good question from Anonymous. Pleasure. What has happened with the Signia Berkshire Hathaway fund and what are the prospects? So that's a great question. So for those Buffett fans, on Saturday, we had some results come out from Berkshire Hathaway. They were slightly worse than expected because they wrote off their craft foods business. And I think it was like $3.8 billion. So it was quite a big write-off. But that business has been struggling since they bought it, and they've actually stepped down from the board and they're giving up on it. So it's not something that people are aware of. I think generally, if you look at the share price for Berkshire Hathaway, it peaked on the date that Warren Buffett announced his resignation, and since then it's down 15%. Now, I think this is a great opportunity because Berkshire Hathaway is something that is incredibly stable. I mean, if you look at the number of transactions that Warren Buffett has done, he's probably bought 10 companies in his 60 years there and sold very few of the companies that he's bought. I mean, he's got his core holdings that he loves and that drive cash flow, his short-term insurance business that drives his float and provides all the cash for all his other purchases. That's something that's not going to disappear from Berkshire. And many of the companies that he's bought, I think, are solid companies that'll be there for at least the next decade. So yes, maybe in a decade's time, the companies that have bought start to get sold down and the new leadership, even though there's been a very strong handover period, I don't think there's going to be a big impact on Berkshire's performance for the next, quite some time, if not a decade. So I think this is quite an exciting opportunity to buy Berkshire Hathaway. They do have quite a lot of cash on balance sheets. So if you do think markets have a long way to run from here, well, then you probably want to go into just the S&P 500, which is more geared to the upside, whereas Berkshire's got a lot of cash. They've got a lot of non-US businesses like Japan, and so they're more diversified, more defensive. And that's another reason why they haven't been doing as well, as people have been switching out of defensives like healthcare, utilities, telcos, staples, and into the more cyclical sectors. So also all depends on your short-term outlook, but I think that markets have run quite hard, and I think that defensive stocks are looking cheap compared to cyclical, and I do believe that Berkshire Hathaway will remain true to its core for some time. So while it's hard to pick the bottom, so I'm not saying buy now, by today because the results only came out on Saturday, but maybe nibble, buy some now and see what happens, and buy some when it turns and starts to pick up. But yeah, I think a good opportunity there. John says, hi Carl, if dollar is set to weaken over the longer term, which alternative currency should one be invested in? John, that is the $1 million question. I showed in the Bitcoin webinar that I did, just because we did launch Signia Life dollar cash fund, and I showed the dollar's reserve currency status of the world, just as I mentioned, how it's dropped from 70% down to 60 over 20 years. And what is interesting is that what's taken the place of that 10% drop, it's not the euro, which is the second biggest. It's not the yen, which is the third biggest. It's not the pound, which is the fourth biggest. It's actually gone into small amounts into China, small amounts into Canada, and small amounts into Australia. So people are definitely diversifying their currencies a lot more. Obviously, central banks have been selling their dollars and buying gold. So I suppose I'd have to say a basket. And the reason I say that is the biggest contender is the euro. But that has a lot of issues. I mean, as I mentioned before, they don't have a fiscal union, which the US does. They don't have a banking union, which the US does. So they don't have any market depth to their bond market. In fact, they don't have a euro bond, which to back their currency. Each country has their own bond market. So there's just not enough depth in the euro for it to properly take on the dollar anytime soon. But over the next 10 years, things could change. Yolanda says, Trump and India seem to be locked heads over Russian oil, correct? What impact would this have globally with new tariffs in India, and what opportunities are there for local investors? Yolanda, that's a great question. So we don't have any direct India exposure. We do have our emerging market exposure, which is about 1/5 China, 1/5 India, 1/5 Taiwan. So we do have some India exposure, but it's not a lot. Certainly. So India's largest exporting partner is the US. So India is heavily dependent on the US. India is also, I think, the biggest buyer of Russian oil after China. So they're also very dependent on this cheap oil they've been getting out of Russia. So it certainly does not bode well for India if these penalties are put in place. But we don't know exactly what those penalties are going to be. Trump has just said penalties. He has referred to 100% secondary tariffs or penalties on Russian oil. I think if it was that big, it's going to have a big influence on China and India. But it's just so hard to say with Trump because one day there's 50% tariffs on copper, the next day there's no tariffs on copper. So this 100% on oil might be 10%, and then it's not something. Then it's something that India could survive. It's 25 plus 10, or at least it's only 10 on the oil. So oil being a small part of the economy comes through even lower. So unfortunately, right now I can't answer your question. It is a risk for India. India do make up 1/5 of our emerging market equity portfolio, our investment that we have in EMs, but I don't think Trump is going to push ahead with 100% tariffs, but we'll wait and see. Gary says, side note question, what are the primary sources for, Gary, I read everywhere. So yes, a lot of the research comes from The Economist, from Financial Times, from Bloomberg. Bloomberg is a big one. We also subscribe to Alpine Macro and to MRB and some other global strategists. So we get a lot of research, free and paid for, that provides us with all the great charts that you see and all the interesting tidbits. Ray says, what are your views overall on SA equities given this context? So, Ray, I think this is just it's an important question. So last month I did talk about our strategic asset allocation. It's our long-term 5-year, 10-year view, and we'd cut SA exposure by 7%. We reduced SA equities by 5% and reduced SA bonds by 2%. So the fact that that was from the 1st of May that we made that change. So the fact that we've now gone overweight SA equities and SA bonds, it's from a much lower starting point. So we actually still very underweight our old SAA, but also it's very much a tactical trade. So we are tactically overweight SA bonds and SA equities on the back of a weaker dollar. So the global influence on the back of low inflation, which again is a global influence because of the weaker dollar. And so we've got, and obviously the huge positive impact to our terms of trade from commodities, which is partly weaker dollar and it's partly all the stimulus that China is seeing. So we've got a short-term tactical view based on positive views on China and views on weaker dollar, but we could change that tomorrow. We could change it in a month or 6 months. But our long-term 5-year, 10-year view is definitely still negative. Why? Well, from a debt perspective, our debt is just not consolidating. Every budget we've had over the last decade, they keep forecasting a point where our debt is going to roll over and start to consolidate, and it just gets pushed out and pushed out and pushed out. And the bottom line is mathematically, it is absolutely impossible for us to reduce our debt if we're growing at 1%. It's just impossible. So we are stuck. The only way we are not going to end up with huge amounts of debt and huge amounts of unemployment is if we can start growing more than 1%. And that requires reforms. And we are starting to see some positives. I mean, it's not all negative. I mean, one of the biggest positives you are seeing is the collaboration between the South African private sector and the public sector. And as we saw with solar panels and load shedding, but we need a lot more of that to happen to tweak our growth. So unfortunately, still negative over the long term. Johan says, what is our outlook for the gold price? Johan, you're asking the wrong person because I've got gold so wrong. I've got platinum right, below 1,000, I said buy, and it's up 50%. But gold, I completely I understand it's going up because central banks are buying it. But effectively, that's kind of a greater fool theory. You've got to buy gold because you believe that you can sell gold to a central bank in a year's time because they're going to carry on buying it. And they most likely will carry on buying gold, but it's just impossible to say. So yeah, I prefer to avoid gold at these levels. It's just compared to the price of getting out the ground, it makes no sense. So it's really working as a currency now, not as a commodity. Anonymous asks another good question. What would you recommend any Bitcoin or other crypto as part of a portfolio's asset allocation? So in the Bitcoin webinar I hosted 2 weeks ago, first of all, you can't put Bitcoin into your retirement fund because Regulation 28 doesn't allow. And if you're using your savings of buying a unit trust, you again can't get access to Bitcoin because unit trusts can't hold any Bitcoin. So you really you're limited to buying Bitcoin through a life wrapper like we are offering it, or you go direct to an exchange. Now, the recommendation that we put onto our fact sheet and our marketing sheet is that you shouldn't have more than 5% of your assets in crypto. And the reason I said that is because crypto really is a commodity or a currency, somewhere between a commodity and a currency. And if you look at prudential limits for something like platinum, well, you're limited to 5% of your portfolio into platinum. So thinking from that perspective, you don't want to put more than 5% of your portfolio into platinum, so you don't want to put more than 5% of your portfolio into Bitcoin. Now, that's talking from a long-term retirement fund investment framework. Certainly, if you've got high risk savings that you want high returns for, and you believe that Bitcoin is going to the moon, and a lot of people do, well, then it's a good place to. Then you might want to have more than 5%. And certainly, I do understand that we're seeing this big switch in Bitcoin from the early adopters into institutional investors via the iShares Bitcoin Trust ETF, IBIT, which is what we use for our fund. And that is definitely going to provide some more tailwinds to Bitcoin. But of course, please have a look at my marketing sheet or fact sheet. The list of risks is like a whole page. Bitcoin has risks. So one of which is quantum, what is the word? You can break the code to get into your Bitcoin through quantum computing. So things like that which exist. But yeah, 5% is the max that we recommend. Okay, Renier says, Kyle, there are some major issues in the performance reporting on the Signet Alchemy system. The formulas used break completely for clients' inflows and withdrawals and severely affecting our clients specifically. Okay, so Renier, I'm glad you have escalated that. I appreciate that note, and I'll certainly follow up and see exactly where those issues lie. As you know, we are investing heavily into our platform. We've got lots of exciting upgrades that are coming, but clearly we have to get the basics right. So I'll follow up on that for you. Anonymous says, are you concerned about the status quo of the US and South Africa? That is a great question. We're one of the few countries that is seeing the same tariff at 30% that we saw on Liberation Day. There's been no negotiations, no improvement, and that is definitely a concern. Is the South African government doing enough? Is the South African government allowing ideological concerns is that preventing us getting a solid economic solutions? And we desperately need solid solutions. And we need investment from the US. We need investment from the West. We also need investment from China, but we need investment to get our growth up. So yeah, I am concerned that the status quo of the US and South Africa is not improving. That said, I'm not surprised. And it is one of the reasons why we long-term are underweight South Africa, because we know that we have ideological differences, which sometimes impede our ability to do things efficiently, like reforms. And in the short term, it's quite fascinating. You look at the stock market, South African financials are up 3% year to date. South African resources are up 60% year to date. So our overweight in SA equities is trying to get exposure to the resource sector. We're not surprised that SA financials have done 2% or 3% because within South Africa we have issues and no low growth, which is a problem. Rob says, why don't you offer the Box Hathaway Life Fund on other brokerages? Rob, so our Box Hathaway Life Fund is a life fund, so it has to be bought through our platform, through our life license. And we can't list our life license onto a stockbroking business. So you can't buy that through stockbroking. Rob says, what funds would you suggest to invest in to hedge against the US tariffs? Well, Rob, that's a solid question. I mean, as I showed you in that chart about the Goldman Sachs index and the UBS index, markets aren't actually pricing in any risk from tariffs. So normally you could wait for some of those baskets to be cheap and then think that tariffs aren't going to be as bad as you expect. But I would say it all depends on what you think is going to happen to the US from US tariffs. Do you think, like I think, that it's going to lead to more inflation? Or do you think it's going to kill growth and actually lead to inflation falling? And it has quite a big impact on where you want to be, whether you want to be in US bonds, which would be the one on basically a weak growth. I think on a weak growth, you could actually see the dollar strengthening, and you could see the dollar becoming a safe haven, and US bonds in particular being very well sought after. But on a strong high inflation scenario, well, that's more difficult. For now, you want to be long equities because that's where the momentum is. But really, the only place to hide is cash. And again, we have headwinds to the dollar, so you want to be in a basket of global currencies, or the other one is emerging markets. I think that's probably, yes, emerging markets are impacted by this BRICS tariff, and there's the transshipment tariff and other tariffs on China in particular. But I think that's a good way to avoid US tariffs. The most defensive position, I believe, is emerging markets, in particular China, to avoid US tariffs. Grant says, hi Carl, any chance of a Signia Life Ethereum Plus fund? Certainly, it's on our to-do list. I can't tell you when, but it's the next one that I'm sure we'll launch. Karusha says, hi Carl, could the weaker dollar make a difference to the impact of the US tariffs on SA, or is it not that weak as yet? That's also a fascinating question, because when we had Trump 1.0, and even earlier on, before Trump came into office, the markets reacted in a very, very rational way. Whenever there was concerns about tariffs, the dollar strengthened. So basically, Trump would say, okay, I'm going to put 10% tariffs on Europe, and the dollar would strengthen against the euro, and it would net off. So there would be no impact from tariffs. But now we're seeing the exact opposite. We're seeing a weaker dollar and tariffs, which makes it quite difficult for South Africa to be competitive, because now not only have we got a strong rand, which makes our goods that we send to the US more expensive, but we've got the tariffs. So it works against us in this time, not with us. And it is one of the reasons why people think that eventually, when growth recovers in the US and the US recovers its exceptionalism, that the dollar will strengthen, because tariffs, the logical way of how tariffs work is that if you just follow the economics and the maths, higher tariffs lead to higher US tariffs means that the US consumer spends less, which means that the US budget deficit shrinks and the US trade account shrinks, which means that the dollar strengthens. So the dollar should be strengthening, but it's not. It's a crazy time to be in the markets. And Dina says, in this environment of high global debt, slower growth, and political uncertainty, which asset classes or themes does Signia believe are the most resilient or upside of the 6 to 12 months? Well, I've always liked healthcare. I think that's defensive, and healthcare works really nicely in an inflation environment. But healthcare's got some specific company issues right now. I'm waiting for that to feed through. But maybe in a couple of months, healthcare will be a great bet. Otherwise, until then, emerging markets we think are the safest place. I mean, we pretty much underweight Europe and Japan, neutral US, and overweight emerging markets. Kamagelo says, hi Carl, is it worth holding investments in pounds, or is the dollar still preferable even with the spread volatility? That is also a solidly interesting question. I think the pound is probably my weakest currency. So I would probably pick the euro first, then the yen, then the dollar, then the pound, if I had to order them. The UK has got a lot of specific UK issues, which make them even worse than an emerging market. So yeah, I'm not a big fan of the pound at the moment. And it looks like final question as we hit to the noonday gun. how do we automatically get the dividend earned on our ETFs to reinvest it back? I see the dividend portion sits as cash. That's okay. That's a good question. That's for Alchemy. There goes the noonday again. I don't think you can automatically reinvest your ETF distributions into the ETF at the moment. It's definitely something that we're working on, but I don't think that's something that is available to. But again, I'm not a platform expert, so please email Signia at SFS and admin at sfs.signia.co to see exactly what the solution is there. Okay, just before I disappear, I've got an answer from the team on the money market unit trust. That is just because of distribution. So the money market fund was up 64 basis points, 0.64% for the month of July. So any negative number you're seeing is because of the distribution out of that unit trust, and you're just seeing a NAV price. You're not seeing the reinvested price. So you need to add back your distribution to see your full total return price. Okay, that's it for today. Once again, thank you so much for joining. I really appreciate your questions. I really appreciate your time. I hope it was useful. And yes, good luck for August. As I said, traditionally one of the more volatile and negative months. So hopefully we have another decent month, but I think it could be a dodgy one. So hold fast. See you next month.